Hi, my name is Lincoln Holbrook, and I'm going to share with you a whole new way of mastering the markets. Now, this new way is less about a trading technique or tactic or a new way of looking at a super secret set of indicators. It's really helping you understand a much more foundational piece to your trading. And that foundational piece is the statistical approach to the markets. Markets, as we all know, the outcome of individual trades is random, but it's possible for you to know with great accuracy what's going to happen over a number of trades. For example, if I were to flip a coin 100 times, you wouldn't know from coin flip to coin flip if it was going to be heads or tails. That outcome is random. But you can predict that over the course of about 100 trades or over 100 trades, that would come up about 50 tails and about 50 heads. It's about a 50-50 result. Now, those results don't come all at once, 50 heads and then 50 tails, or it doesn't come alternatively, head, tail, head, tail, head, tail, head, tail. It comes in streaks. And so we're going to talk to you today about how you can change your whole way of looking at your trading to give you a more sophisticated way of approaching it. We can give you an expectation about what your results will look like so that you can then measure whether or not you're actually achieving the expected result, which is how professional traders manage their markets. Now, before we get started, just know that I'm not a legal or licensed investor or trader or financial advisor. I'm not a lawyer. And so all of these things that I say to you today are just for educational and training purposes only, though I do want you to be a successful trader. Now, I have just a little bit about me. I've traveled all over the world teaching thousands of people as the first employee of InvestTools back in 1998 how to trade in the markets. I taught their system. It was a buy on 3 green arrows, sell on 3 red arrows kind of system. We try to make it as simple as they could. And I realized that people weren't being very successful at that. I actually wrote a book, The Emotional Habits of the Successful Investor, to try to help people overcome some of the consistent problems that I saw people struggle with. You know, the mind games and the self-talk and the glitches that would happen that would cause them to make mistakes. Several years ago, 2013, I started my own training company, and I devoted the resources of that company to try to figure out what it was that made people struggle to have consistent success in the markets. And what I found over those years and several $100,000 is that people struggle because they're missing a secret piece, right? They're missing a key component to everything else is based on. All of the educational components or the programs you subscribe to, the books you've read, all of that stuff, they're talking about edge techniques. It's not talking about a fundamental approach to give you what we call a base win rate and the expectation of that. Some of the problems that people have told me that they've struggled with: fear of loss overwhelms their decision making. They're so afraid of losing money that they can't make any money. They don't trust, and they can't follow their trading plan. One of those 3 things. They generally operate on a buy, then hope, wish, and pray for a profit. Now, there are those people out there who use set it and forget it strategies. They just hire a financial advisor, and some of them are lucky in that they're making so much money that they're able to save enough that even if their advisors aren't doing that great, they're still doing okay, right? Ready for retirement. But most people, they know that won't work. They can't save anymore, and they're not anywhere close to where they need to be. They need to put their money to work at a higher rate. They already understand that low single-digit returns, which is what mutual funds have averaged over the last 20 years, just isn't going to get the job done. They need bigger returns, but they don't know how to get them. So they become more like gamblers, or lottery ticket buyers. They do something and they hope they get a big profit. They have no way to form an expectation about what results should like in a given approach to the markets. Whatever that strategy is that you're following, no one tells you. I've worked with lots of experts, and none of them ever tell their people the kind of results they should expect over 100 trades. This is your base win rate. Nobody talks about that. We are talking about that because we know that's the only way for you to be able to gain consistency over your trading and to improve those results over time. Now, as part of our research, we came across this quote from Charlie Munger, Warren Buffett's closest partner and right-hand man. Warren Buffett, of course, owns Berkshire Hathaway. He and Charlie Munger basically turned Berkshire Hathaway into billion-dollar company. It's a multi-hundred-billion-dollar company, and they became billionaire traders not because they started that way, but because they traded the right way for them. And he said, some people with high IQs are terrible investors because they've got terrible temperaments. That is why we say that having a certain kind of temperament is more important than brains. What he's really saying is, look, not everybody can trade the way we trade, and those who can't trade the way we trade, we don't want them. We only want people who can trade the way we trade. Now, our research has found that there are literally 5 different types of trading temperaments, okay? 5. There are those people who are so afraid of loss that it's almost debilitating, but they're able to do it, and there is a way that they can approach the markets as long as they win more frequently. And they're willing to give up big wins, right? They don't care about having big gains or not. They're okay having lots of little tiny losses because they're so afraid of a loss. And so there are strategies that play to those strengths. But you need to know what those strategies are, and you need to match them to you so that you're following the right strategy, so that under the stress of trading, your natural tendency will be to make the right choices. You won't be working against yourself. These people are kind of equated to the dragonfly in the sense that dragonflies capture about 9 out of 10 hunts. Whenever they go on a hunt, they win about 9 out of 10 times. These people will win statistically 75% of the time or more. In exchange for winning that frequently, they're willing to give up, like I said, the possibility of large gains, and they'll sometimes have fairly large losses, especially in relation to their gains. Win frequent style traders aren't extreme, but they do like to win more frequently than they lose, and they're willing to risk 2 to make 1. Okay, that's the way they structure their trades. They're risking 2 to make 1. They're going to win about 66% of their time. Again, they're going to have small gains, not as small as the win frequent extreme players, but still willing to give up these large possible gains for and accept a few larger losses in exchange for having a more frequent winning rate. The just win style traders, they're kind of like Peregrine Falcons, who only win about 5 out of 10 hunts that they go on. But they prefer to emphasize leveraged trading opportunities. Their goal is about a 50-50 win rate. They're willing to risk 1 to make 1. That's how they structure their trade, risk 1 to make 1. Now, once they start a trade and it's moving forward profitably, they know what to do to let those profits run. And that allows them over time to make some significant profits. They're willing to buy options, sell options, buy or short stock. It doesn't matter the strategy for them. They just want to win. Win big style traders, they're more like jaguars. They go on hunts after big game. As a consequence, they only win about 1/3 of their hunts, right? They only win about 1/3 of their trades. That's about what the jaguars do. They want larger sized gains compared to their losses. They're willing to make more losses or have more losses than gains. And the way they structure their trades, they're risking 1 to make 2. And then there's the win big extreme. Those are people who literally they're so focused on that big win. It's such a rush for them that they will willing to risk 1 to make 3+. They're going to have a lot of small losses, but their gains are going to be much larger considering, compared to their losses. And so for them, they can handle the losses. They don't get freaked out. They don't get afraid. They don't get paralyzed. They don't stop trading when they have losses. They can keep going. And that's where you need to adopt a strategy that fits who you are as a person. Now, the purpose of this video is to help you understand that you can prove all of this to yourself. And we're going to show you how you can prove this to yourself with no technical analysis, no edge technique, nothing. It's just a random chart. We know that chart comes from the last 20 years, and we know that chart is from a stock in the S&P 500, but we don't know anything about it. We don't know its symbol. We don't know the time frame of the year, nor the decade that it was in. We just know that it happened. It was a real chart. You can go to chartgame.com to figure it out. We're going to give you a spreadsheet, and we're going to walk you through that so that you understand how to trade. so you can follow the rules of the game. And we're going to have you journal every trade. Just the first 30 stocks you run into, journal those stocks. You're not trying to game the system at all. We just want you to analyze the results so that you can prove to yourself that it is possible to get statistically relevant expectations over a number of trades. You won't know from trade to trade if you're a winner or a lose, if it's going to be a gain or a loss, but you can forecast with great accuracy what's going to happen over a number of trades. Okay, we're going to ask you to trade the win big style, regardless of your personality. We'll adapt that when you come work with us, or we'll find that out for you when you come work with us. In the meantime, we're going to have you try a win big style trading approach, which means you're going to risk 1 to make 2. To get to the chart game, you just go to chartgame.com and you get to a page that looks like this, and you click on the Play Now button that's circled in red here, Play Now. Then you go, they'll ask you to log in using your Google account. If you have a Google account already, great. If you don't, open up another tab and create a Google account. It's free. And then use those credentials to log in to the chart game. Once you get into the chart game, it's going to ask you, it's going to take you to this page, and then you get to choose. See, in the upper right-hand corner, there's 2 blue buttons. Click on the one that says Play Swing Trader Simulation. Now, we're going to play this swing trader simulation, and we're going to do the 30 trades and fill out our spreadsheet just like we would want you to do. And we're going to do that for time purposes super fast. So here we go.
And the goal here is that we just take a look at the chart and we say, okay, I see the chart. The rule is I'm doing research today. I'm going to buy at the open the next day. And the open in this particular case was $27. You can see up here at the top. $27 is the open. The high is 27.22 is the open. The high is 27.75. The low is 27.22. The close is 27.75. So then we just come up here to the open price of 27.22. Oops, wrong place. $27.22. The daily ATR, remember we're going to risk 1 ATR, meaning that's our stop loss, to gain 2 ATR, which is our profit target. It's between 75 cents and 50 cents, closer to 50 cents, so let's say that's probably going to be about 60. Means we're going to get out at a loss if it goes down to 26.62, or we're going to get out with a gain if it goes up to 28.44. The high for this day was 28.19. That's obviously a 28.42 for that particular trade. And these charts are just random. They come from the last 20 years of historical data. We don't know what chart, what company, what time frame. We don't know anything about it except the price. And we're not using any other indicators. We're just going to keep it simple. We get to the chart today. We decide to buy at the open tomorrow. 1536. The daily ATR is just between 3 and 30 cents and 40 cents, so we'll call it 0.37. We'll get out to the downside at if it goes to 14.99, we'll get out with a profit if it goes up to 16.10. The low on this day was 15.03, not our profit target or our stop loss yet. The high on this day was 15.98, not our profit target yet. But now it is 16.10. End game. Next. The open was 48.06. The stop loss or the ATR is about 85. So if it gets to 47.21, we're out, and it's below that on the same day, so we get out with a loss, 47.21. Now we want you to go through this yourself the rest of the time. I'm going to do it, but I'm going to do it on fast speed, so I'll get back with you at the end.
Now, once you've finished your trades, you'll notice that you get to a chart that looks like this, or you'll finish your spreadsheet, which ends up looking something like this. Now, I did random, so your numbers won't look as like mine because you took random charts too. But the whole point of it is down at the bottom right-hand corner, you can see that the winning percentage in random trade using no edge technique, a win big style where you're expecting to win 33% of the time or so, somewhere between 30 and 40% of the time, you won exactly 40% of the time, okay? In this particular instance. Sometimes it's going to be lower, but in this particular instance, with no struggles, no gaming, no technical analysis or any sort of edge technique, not knowing anything at all about the companies or the stock market time frame whenever this is done, you're still able to win about 40% of your trades exactly as we told you you would, okay? The expectancy is a number that tells you about how much you'll gain for every dollar you put at risk. In this case, it's 22 cents for every dollar you put at risk. We can change this number or improve this number using edge techniques. That's what edge techniques are going to help you do. They're going to help you take a base winning rate like this and grow that so that you're, number one, winning more trades and you're going to have a higher expectancy. If you have an expectancy of 0.2 or more, you're probably going to be consistently profitable in your trading and you'll be a happy trader. Some people that I've worked with have had expectancies 3, 4, 5. Those are rare, but it is possible, which means for every dollar you put at risk, you could get $3, $4, $5 back. That's an unbelievable expectancy. But generally, you want an expectancy over 2. Now, all of these things can be done by people who don't know anything about math and who are never really traded in the markets, and it will certainly help those who have traded have more control over their results and more confidence in their ability to achieve more consistent profits in the market. Until next time, I hope that you have great success in your trading.